Hi, I'm Emily Perry, and I'm the Senior Economist at TCorp. I recently had the pleasure to talk to two very interesting guests. The first was Gerard Minack. Gerard is the CEO and founder of Minack Advisors. He's one of the world's most in-demand macro strategists and is well known for his honest and insightful views. His clients include some of the world's largest and most influential fund managers and investors, including TCorp. The second guest was Simon Murphy. Simon works in TCorp's investment management area as head of Treasury and exposure management. Simon has 20 years' experience as a global bond investor, and before joining TCorp, he worked for a global insurance company. Simon and Gerard both joined me for a great discussion about a few topics that are certainly front of mind for investors at the moment: geopolitics, AI, and views on Australia as an investment destination. Here's my conversation with Gerard and Simon. Gerard, thank you very much for joining us today. How are you?
Yeah, good. Thanks for having me. Looking forward to it.
Yeah, me too. Simon, thank you. How are you?
I'm great. I'm very glad to be here. 2025 was a roller coaster year for investment markets, so happy to talk about it.
So the first topic I wanted to talk about was geopolitics, because as you know, a lot has happened in this space, and most has been centred on US policy making. US policies have instigated big changes to global trade and defence, including more recently with developments in Venezuela and Greenland. Investors were certainly rocked by President Trump's tariff announcements in April last year, but have barely responded to developments since then. Equity markets had another very strong year last year, and bond market investors don't seem to have been too fazed by these events. Gerard, why do you think markets haven't had a larger reaction? Do you think it's because there's just too much uncertainty that investors don't know how to respond, or are investors being a bit too complacent?
Emily, I think there's a couple of reasons. I think financial markets have a history of being slow to react to geopolitical change. And you can look at monumental events like the assassination of Archduke Ferdinand that kicked off World War I. I went back and looked at the books. The gilt market moved 2 basis points that day. And we look back in hindsight and go, well, this kicked off the greatest war of history to that point. So that's the first thing. Markets aren't good at calibrating geopolitical risk. I think there's a second specific issue with Mr. Trump. We've become to view the taco trade, the Trump always chickens out trade. And that was established in the response to that Liberation Day, the one time the market really did worry about the geopolitical consequences of his tariff announcements, and then it backed back, and we took that as a lesson. Okay, every time he comes out with something, he won't ever stick to it, and the market just needs to have a little bit of a wobble, and he'll back away. Now, the risk in all that, obviously, is he'll go, well, markets are letting me get away with it, and go stronger and stronger until we do get to the point where there is a big reaction. The final point I'd make about this is I think some of the changes that Mr. Trump is producing are best seen not as discrete shocks that need a response in a very short time horizon, but a bit more like Brexit has played out. Brexit was on the day, their vote, a shock. Everybody nerves stopped jangling and nothing seemed to happen. But 10 years later we look back at it and we go, well, UK GDP is probably 5 to 10% lower than it would otherwise have been. Investment is a lot lower. The equity market's underperformed and sterling's weak. So these things are a slow burn at times, and perhaps we need to look back in 5 years' time to see how the market did react to the geopolitical changes that Trump is unleashing.
Yeah, well, that makes sense. Another concern over the past year has been the risk to US assets. If the US's relationship with its allies does get more strained and global investors start to pull money out of the US or invest less in the US in the future. Simon, have you seen any signs of foreign investors changing their behaviour with respect to investing in the US, particularly bond investors?
I think there's a lot of talk about this, and there are a couple of things you need to consider. Is that if money comes out of the US, it actually needs to find another home. And the US markets are very deep and very liquid, and there aren't many other alternatives. So how I would characterize what's happening at the moment is probably a few years ago we talked about the idea of quiet quitting. People just aren't as enthusiastic, say, at work, and I think that's what's going on for global investors. Maybe they're not quite so enthusiastic about putting money to work in the US. Doesn't mean they're taking any money out of the US, but they're probably starting to look at other markets. And we have heard stories that investors, when they assess certain markets and investments, are now asking for a bit of a premium on US assets that perhaps they didn't need before, but now they want to be compensated for that political uncertainty and some of those risks.
I mean, I get the sense that focusing more on equity investors, that they've been happy through last year to continue to own US companies, I mean, partly because of the AI thematic, but they've become a bit more cautious on the whole US risk reward, and what they've been doing is hedging the currency. So what we saw last year was the dollar weaken in the first half of the year. US equity still gave decent returns. So in other words, yep, love your companies, not too sure about your politics, and the way we express that is by increasing our currency hedging.
Gerard, you mentioned AI there, and clearly that's been an important theme and a significant driver of financial markets in recent years. And there are so many aspects to that AI theme. So, for example, thinking about how it might affect workers and productivity, how much it's driving economic growth, thinking about whether the huge investments that the AI firms are undertaking will be profitable, questions around whether AI is in a bubble, and the list goes on. So Gerard, what aspects do you think investors should concentrate on amongst kind of all of these questions?
Emily, I think we need to separate the economic impact of AI versus the investment decisions. And I mean, a good illustration of why we need to make that distinction is to go back to what happened in the TMT cycle in the late 1990s. I mean, that was all about digital technology, and that digital technology has transformed the world. It's ubiquitous, it's useful, and here we are doing a podcast that's going to be distributed down digital distribution channels. But back then, people thought that if this is the new big thing, controlling the distribution channels would be a terrific, profitable business. And so we went bananas on things like telcos. We now consider them boring utilities, but back then we thought, well, if telcos control fibre optic networks, they're buying mobile phone spectra, this is going to be terrific. Sorry, it turned out to be a boring commodity business. And I can see some analogue with what we're doing now with the AI trade. AI could be ultimately transformative on a 5-10 year horizon. The big investment question is, how profitable will the provision of AI services be? And right now, the equity market seems to believe it's going to be a gold mine, and I'm just sceptical about that. And the principal reason I'm sceptical is I can't see that it's going to be a winner-take-all industry. I think it's going to be contestable and relatively low margin, and therefore the skyrocketing capex that these companies are putting in place is going to get disappointing returns. So I'm cautious on the AI trade as an investment thematic, even though it may be transformative as an economic development.
And Gerard, you mentioned the investment that's going on there, and there's been a lot written about it. I read recently a piece by Morgan Stanley that suggests that there's about $2.3 trillion of investment over the next 4 years required, and about 1.5 trillion of that is going to come from borrowing. So you're all over this, that a lot of this investment so far has been financed out of retained earnings. But we're now at the point where these hyperscalers are starting to borrow quite a lot of money. And in the final quarter of 2025, they borrowed about $100 billion. And that was very much them coming to the market for the first time to really borrow in size to fund some of this capex. And I think it's an interesting point, because these pesky bond investors, they have this habit of asking, well, how are you going to pay me back? And the difference between equity investors and bond investors is that, equity investors, there's unlimited upside, but as a bond investor, you lend your $100, and at the end of a few years, you get your $100 back. So you want to be sure you get that capital back. There's no real upside for you other than getting your coupon payments. So I think it's going to be really interesting, because these hyperscalers they're going to have to explain what their revenue model is and how they're going to grow the revenue from AI.
And arguably, the most vulnerable part of the market is the bit we can't see, which is the unlisted sector. And I mean, this is one of the big differences between this AI boom and the TMT boom. The TMT boom was all on public display. As soon as you had any half-baked idea, you floated it. Now, a lot of the biggest companies are still in private hands, but they are huge companies. I mean, the last cap raise, apparently OpenAI, which is the creator of ChatGPT, was valued at $500 billion US, and at that stage was generating sales of less than $20 billion. So this is a $500 billion US company on a price to sales ratio of over 25 times, massively cash flow negative. So they need to rely on every which way to get money, both more equity issuance, but also debt. And as you said, the equity people see the upside, the bond people are worried about return of money, not just the return on the money.
So there is a lot of talk about whether AI is in a bubble. So Gerard, what do you think makes something a bubble? Could it just be the sort of high share prices, or does it need to have an aspect of debt in there as well?
I don't think it needs an aspect of debt. Look, almost every bubble is a good idea taken too far. And just like TMT, the digital technology was a great idea. You end up having people launch companies like pets.com, which famously went bankrupt 9 months after launch. And here in Australia, we had mining companies that stuck .com in their name and got a bid. So you have a lack of discrimination and people just going bananas. I think we are entering bubble territory. I don't think it's quite as ludicrous as it got in the TMT cycle. But I'd come back to the fact that when you do have $500 billion companies on a 25 times price to sales ratio, that is pretty bubblish. And I do think we're making the same mistake about the returns on the capex that these companies are investing. So ultimately, the upshot of that is I think the market's overshot and we will have a show me the money moment when there'll be a reckoning. And certainly the hyperscalers won't go out of business. They've got great legacy businesses that are profitable. Their share price can fall. But some of the private companies that are the pure plays in the AI space, I doubt that they'll all survive as standalone operations on a 2 or 3 year view.
And would your expectation be that it would cause a fall in risk assets, or do you see it having broader economic implications?
Initially, I think it's more about a rotation in the equity market. Once again, I go back to what happened in the TMT cycle. In calendar 2000, the NASDAQ basically halved. The rest of the market went up 20%. So Warren Buffett, famously eschewing investing in tech, had a cracking 2000, had a great return. So I think that's analogous to what we might see initially. Then there's going to be questions about, well, the AI capex was a big contributor to growth. I think some of the estimates of the contribution are exaggerated, but I agree, it's been a factor. I think it's probably been adding 0.3, 0.4 percentage points to annual growth in the US. Now that's not nothing, but if that suddenly got taken away, it's not necessarily a hammer blow. It doesn't inevitably lead to a recession. So a slowdown for sure, a recession, let's see what else is happening at the same time.
I might sort of swing to geopolitics in Australia. So we spoke earlier about sort of rising geopolitical tensions and the unpredictable policy making coming out of the US. And one way investors have been responding to that is by investing more in precious metals like gold and silver. But something we've been thinking about is whether Australia could become more of a safe haven location for international investors, particularly bond investors. So if you think about what's happening in the external environment, combined with the fact that Australia has a relatively favourable sort of demographics, a stronger fiscal situation and an independent central bank, it seems plausible that Australia could be viewed in this way. Simon, do you think this is a possibility? And what would need to happen for Australia to become more of a safe haven? And what implications would that have for Australia's economy and financial markets?
So I think, Emily, based on the discussions we've had with our counterparties, that it is already starting to occur. And I think it's about that earlier theme that you talked about, investors becoming more cautious on the US, and particularly investors who are worried about the return of capital and perhaps having their capital confiscated after what we saw with Russia and Ukraine in 2022. So a lot of countries are choosing to diversify their reserves. And so some of that is probably coming into Australia in terms of purchases of Commonwealth government bonds, but also we're hearing state government bonds, or semi-government bonds as we call them. And the investment case is actually quite compelling. So if you think about a 10-year Commonwealth government bond today, the yield's pushing up onto 5%, which is a nice return. If you look at sort of a slightly longer, sort of 15, 16-year-old, 16-year maturity from TCV, you're looking at 6.1%. So those are, they're good numbers for investors, especially based on where we've been in the, pre-COVID with policy rates basically at zero. So that's very, very attractive. And then there's that reassurance that investors get from Australia in terms of the legal system, the respect for property rights, and independent central bank. So Australia does have a lot going for it. We're probably going to, if that is happening, we hopefully start to see a stronger Australian dollar as well.
I think it's one other aspect I'd focus on, and I've heard from some of my offshore clients, which is, rule of law, all that are absolutely essential ingredients to treat something as a haven asset. But we've also got the benefit that if they are also concerned about upside inflation risks, and that often is associated with rising commodity prices, that is often associated with a rising Aussie dollar. Mm-hmm. So by buying, for example, Aussie bonds denominated in Aussie dollars, you're also part hedging against some upside in inflation risk in a way that you wouldn't expect if, for example, you were going to buy a Singaporean bond or a UK gilt. So there's an extra cherry on top of the cake.
Yeah. The one caveat I would make is, ironically, one of the challenges for offshore investors is that the Australian bond market isn't that big. So the Commonwealth government has about 900 billion of bonds outstanding, and the states have roughly about 700, 800 billion as well, so getting up there. It sounds like an awful lot of money, but if you look at the US Treasury market, they've got $38 trillion. You look at the Japanese government bond market, 11 trillion. So Australia, it's very attractive, but what these offshore investors are often looking for is the ability to actually invest in size and the ability to transact in size at very low transaction costs. And so that will be a bit of a challenge for them. If you look at the other AAA government bond markets around the world, the big ones, Germany, Canada, they have $3.5 trillion roughly on issuance. So Australia, if anything, it's the size of the bond market that will sort of keep some investors away.
So the problem is we're not indebted enough.
Exactly, Gerard. Don't tell the government.
Yeah. And how should investors respond if they see signs of this happening? Do you expect it to be Gerard, like you mentioned, a very slow, one of those other slow burn signs that happen, and just do you expect it to have a meaningful impact or just be kind of marginal?
I'm probably leaning to the marginal side of it. There's a huge debate about how much America's exorbitant privilege, i.e. the fact that it's the world's reserve currency, how much that has affected its ability to borrow. And the estimates I've seen have suggested 25 to 40 basis points, in other words, less than half of 1%. Now, that's not nothing, and when you've got so many trillions of dollars of debt outstanding, that saves you a fair bit of interest payments. But if that's what the world's global currency, reserve currency benefits from, and we're talking about some of that, those crumbs falling off the table, we might be talking 10, 15 basis points. Yeah. Nice to have, but it's not a game changer for us.
It's hard to talk about geopolitics and what's going on and ignore what gold has done over the last few years. And to me, what gold is telling you is that people or investors are worried about return off capital, to use Gerard's phrase there, not necessarily return on capital. So typically when real interest rates are high, that's not good for the gold price because it doesn't have any income, it doesn't have a dividend. In fact, if you're taking physical delivery, you've got to pay to store it. But what we've seen over the last couple of years is gold really on a tear. And that's kind of that diversification story as well.
And I guess one of the things there, it illustrates a point you made, which is the US is a massive asset class, and you don't need much coming out of that to, gold is a tiny little asset class. It just explodes in price, but relative to the US, almost every other equity market, treasury market is relatively small. So outflows from the US that can have a modest effect on their pricing can have an explosive effect on the recipient's price, and gold, silver are illustrating that at the moment.
Yeah.
Yeah. So I asked the question around whether foreign investors were becoming more cautious around investing in the US. Have either of you seen a change in behaviour of US investors? US based?
Not yet is my short answer. I mean, every investor has to some extent a home bias, but no one does home bias better than Americans. And let's face it, for 15 years, if you've been an equity focused investor, it's been damn right to have a home bias, because US equities have cleaned up in terms of relative performance. So from that starting point, I suspect that they'll probably be almost the last to adjust. It's the investors in Europe in particular, which had the flip side. Home bias has cost them over the last 15 years, so they've always been scouting the world for other opportunities. They've become quite concerned about valuations in US equities. They're also concerned, obviously, about the geopolitics. They're the ones that have started to hedge some of the currency, even if they haven't started to downweight their equity exposure. So I think they're going to be the first to move. And yes, the US will start to take note of this probably a year after the peak has passed in US relative performance.
You are seeing strategists talking more and more to their US client base about making sure they're diversified and increasing their diversification and looking offshore. And part of that is currency related, and the fact that other equity markets look relatively fairly valued. If you look at things like an equity risk premium, they do seem to offer very good value compared to the US, and also getting away from not just the country bias in the US, but also the concentration in the S&P 500. And Gerard, you've written lots about this and the size of the contribution that the hyperscalers make to the S&P 500 now. It's pretty significant. So, yeah, the other thing to think about here is the US dollar. So that, that could be the release valve for some of this risk, and what we've seen since Trump came into office is actually a softer US dollar. And I sometimes wonder, is that part of the plan? Is it something that they actually want? If they want to bring manufacturing back to the US, then perhaps that goes hand in hand with a weaker US dollar.
Yeah.
And I suspect relative returns go hand in hand with the US dollar. There's a long history of that happening. So when the US equity market's outperforming the rest of the world, dollar tends to go up, which reinforces that outperformance if you're measuring your relative performance in terms of common currency. And last year was a great example of that reversing. First half of the year, culminating in the Liberation Day sell-off, US equities down, the dollar down, depending on the measure, about 10%. Second half of the year, US equities start to come back and the dollar stabilises. So it just illustrates that link between asset performance and currency, and my view would therefore be, if you expect sustained US equity market underperformance, you should also expect sustained dollar weakness. And I agree with you. That is probably something not something the White House would push back against.
Yeah, I think it's interesting points to also think about the asset class performance, aligned with the currency, but also the fact that those currency decisions can be managed separately. So we've covered a lot of ground today. Thank you both. Before we finish off, I thought I'd get a bit of a last thought from you both. We talked about AI and how important it is as a theme in markets, but I wanted to find out, how are each of you using AI in your own lives, if you are? Gerard?
Look, I'm a boomer. I'm still coming to grips with email. I'm a long way from the IT cutting edge. Tried it a couple of times. It's okay. I'm going to stick to thinking the old-fashioned way.
How about you, Simon?
Yeah, I have to admit I am using AI, and I do find it very useful. I'm beginning to get a bit fed up of being flattered constantly by ChatGPT. It's becoming a bit tedious. I think there is one weakness in AI. It doesn't appear to have any plan as to how it's going to pick up the laundry off my 14-year-old daughter's bedroom floor and put it in the washing machine and dry it and fold it and put it away.
Well, thank you. That's very interesting to learn that little fact about you both. So thank you very much for joining us today again, Simon and Gerard, and for a very insightful discussion.
Thanks, Emily.
Thank you.